And welcome back for this second session. I hope you all had an enjoyable lunch, and we have a very, very lively session to get through. We've got a lot of different panels, and we hope to have some time for questions throughout the day. So I want to make sure you're all alive and well and alert, and we're looking forward to also to, of course, to your interactivity and your questions in this. I think the banking session went very well. Thank you so much for your very pertinent questions, and I really think our set of bankers did a fabulous job in making sure they were able to answer it. We did put them on the spot, I realise, so we're very, very grateful for them for being as good-humoured and as honest and just being with us and available for that session. Now, this afternoon we're going to be looking at raising funds through financial instruments. We'll also have a rapid-fire session. We're going to look at the case for cloud computing, for microfinance, and also take a look at just the legal framework that's out there and some of the issues that you're going to have to deal with. So our first speaker this afternoon, and please, if I might ask you, please do join us. Settle down. I can't have any loiterers by the door. Please join us and get comfortable, and we'll get this session underway. Our first speaker, of course, this afternoon is an expert in the capital markets, a man who has more than 30 years working in global financial services industry and indeed right across the world, Europe, Middle East, Asia and America as well. So we're going to take a look at the strategies for raising funds through financial instruments. And we heard from the bankers this morning, not always easy to raise funds direct from the banks, but there are other ways that we want to look at raising funds. So please, I want you to give a very, very warm welcome to the Managing Director from the Karachi Stock Exchange, Mr. NADEEM NAQVI.
Right. Good afternoon and Assalamu alaikum. It's a great pleasure and an honor to be here today. I know post-lunch is one of the most difficult sessions to go through, not just for the audience, but for the speaker. But I'll try to keep my presentation fairly short, and we will have some questions and answer sessions. Please feel free to ask any questions you have after the presentation. What I was required to do was to discuss the various corporate financing decisions and instruments that can be theoretically used in order to make your capital structure the most optimal. What I will do is that I'll quickly go through the presentation. Some of it would be basic to the professionals here, but I just want to build a foundation on which to discuss a case study that I was personally involved in terms of an acquisition transaction and how the financial structure was created for it, and also explore whether in the case of Pakistan a better financial structure could have been possible. There are three strategic decisions that are crucial drivers of value for the business if you are an incorporated entity, or for the shareholder sponsor if you are a partnership or a proprietorship. And these are very fundamental questions in the investing decision, the financing decision, and the dividend decision. You would only invest in a business that would give you a return greater than the minimum required return. And we will return to this issue of the minimum required return, because that is the cost of equity, or when you bring in debt, the cost of capital. I think there's a lot of confusion today among even professional cadre as to what really is the cost of equity. Then there's the financing decision, the optimal mix which maximizes the value of the project and matches the maturity of the assets being financed. A lot of the times what we do is to go through shortcuts. We have a long-lived asset and we finance it through short-term financing, and there's a mismatch, and then we expose ourselves to a myriad of risks, not just the business risk, but the financial risk in terms of interest rate volatility, changes in policies, and so on and so forth. And finally, we have the dividend decision. Once we understand what the cost of capital is, if we are in a business that is beginning to mature or shows signs that the return on equity is equal or below the cost of capital, it is perhaps a better way to go forward and return the money to the shareholders, i.e. pay it off with dividends. So dividend decision is also a crucial part of your capital structure decision. Very basically, Finance 101, 3 forms of financing options: bank debt, commercial paper, and corporate bonds. There's a hybrid, which is not that much common in Pakistan, but it is available: convertible debt or preferred stock. And there's, of course, equity, which includes the sponsor's equity, venture capital, common stocks, and warrants. But why do we need external funding? You are either a company that is already there, or you are thinking about getting into a business. You will invest only because you expect a return on your investment. And you invest because you see potential for growth for a specific business. So I think return prospects and growth prospects are the only 2 critical reasons why you would want external funding. Otherwise, why would one want to go into lots of covenants and conditionalities and restraints in getting money from somebody else? But how much return? Investing entails taking risk. People who are the entrepreneurs in this room know full well what risk-taking means. I think a lot of professionals who are career professionals do not really realize the amount of guts that are necessary to become an entrepreneur and take risk with your own money. But the dynamic of return and risk determines whether you will invest or not. How much return will you expect or require to put your equity into a business? That is really the cost of equity. And the greater the assessment of risk, the greater will be the required return or the cost of equity. The question is there a benchmark for expected return on equity that you can put into a business venture? And what is that benchmark? There are 2 perspectives I would like to just share with you here. One is the finance theory approach, which looks at equity risk premium. The basic finance theory approach is that the required rate of return on equity is equal to the risk-free rate times a volatility component, which is beta, and the market risk less the risk-free rate. Now, what it means is that the required rate of equity is the sum of the risk-free rate and the equity risk premium. Over a 20-year period from 1991 to 2011, we see that the 10-year average PIB rate, which is the risk-free rate, was about 10%, while an equity return, as measured by a hypothetical index, the KSE 100 index in this case, was about 20%. What it shows is that in Pakistan, to invest your equity in a business, you would require a 10% or more premium over the government bond rate. Another perspective is to look at the actual reality on the ground. And that is to look at the ROEs generated by companies that are publicly listed, where there is generally a higher degree of transparency and relatively better governance. So you can say that the numbers that come down at the bottom line are fairly robust. A 10-year historic ROE range for the KSE 100 companies is between 20 to 25%. For unlisted companies, of course, one can postulate that the real ROE is higher. And that is not always shown in the official balance sheets, but I think if one goes to the sponsors' houses and their bank accounts, you can see that the ROE is definitely higher than what is shown on the balance sheets. Net, you invest in a business in Pakistan when your minimum ROE is around 20 to 25%. This is the cost of equity in Pakistan. Just to give you a bit of a background, in the last 10 years, the average return of the equity market has been about 33%, and the PIBs has been about 10%, and there are some other asset classes here. The 33% shows that actually the equity risk premium has risen over the 20-year average, which is actually 20%. Once you cross that threshold of looking at the equity risk premium, you have to then look at the entire capital structure. And we all know, as CFOs, that leverage increases your EPS, your net profit, because